Thank you very much, Julius, Bernard, and Vasken. And I think Hikmet was going to join us here. And we want to open up this session with about 25 or so minutes for Q&A, and we want to see the questions in the room. But perhaps as we get the mics ready and move around to see who has a question, I want to ask Julius a question. Julius, you know you've spoken about... Can I see those who have questions? I can see two there. I see a third one in the capital markets, and you've shown an example. But the reality is that we've seen limited cases of M&A deals, investors exiting through the capital market. And the preference seems to be, directly away from the capital market. What is the challenge? Why are we not seeing activity of M&A through the stock market?
Thank you, Steve, for that question. I didn't talk about what Helios have managed to do. And very quite successful story. It's almost like a serial transactors and exiting through the capital market. So the deals are there. I think what tends to happen a lot is once the company is ripe to go for an IPO, typically you need an investor. Can I say, to fatten the cow first? And we actually see in the M&A deal, it's a very good avenue for investors, particularly PE funds, actually creating value, because they're able to actually pre-invest before the entities are ready for an IPO. So they are there. The valuation remains a challenge. Ideal candidates remain a challenge. Sometimes the valuation ranges between the buyer and the seller is a challenge. We have seen due diligence questions, particularly lack of information on the entities which are trying to sell stocks, or where the investors try to invest, where there is actually not transparency information. So those are some of the challenges. But once you get a good partner pre-IPO, they are able to fix that. And that's also what happens in the case of Equity. I'm not saying their books were bad before, but Helios and the rest who invested in that, I believe IFC was also there at that point, were able to create more value and provide capital for growth to be able to realize better prices for then investors.
Thank you. And maybe a follow-on question, picking on one of those challenges, valuations. In a situation like Ethiopia, and valuations applies both for M&A and capital market, because we still need to determine the share price as we issue. In a situation where financial information data is unavailable and not perfect, what are some of the solutions to actually arriving at those valuations in a market like this one?
That's a very good question, Steve, and perhaps I'll give an example I was involved in. I think in around 2006, I was a manager for Kenyan IPO, which was, I think, one of the IPOs which really spurred back Kenyan stock market to life. And we did the usual things as accountants. I think she did very good thing for promoting us, and did all the valuation, the mathematics, everything behind there, and we came up with the price. And we end the stockbrokers in the room, and we say, Julius, the price you're given us can never fly. It can't work. There will be no investors. There will be no retail investors willing to buy at that price, overpriced. And we had a lot of debate and tried to figure out how do we then get the right price to introduce this. And eventually we did what is called book building, which is going through a few corporates, say, you are selling this entity. You have seen the IM, which you have prepared, which was listed. What do you think the price would be? And you talk to Vasken, you talk to Bernard, you give us the price, and eventually during discussion actually came up with the price of that. So you can actually do a bit of market sounding, but a lot of times when you prepare and get the data and you are able to, if the company is doing well, there will be actually, and the investors will be able to see, and there will be a price which will be determined there.
Thank you. I'm still waiting to see somebody with a mic somewhere there. And maybe as I wait for that, Hikmet, yesterday there was a discussion around ESG. And we are talking about M&A deals in the African context. From where you sit, is ESG a deal maker or a deal breaker? Is there a conflict between commercial operations, profit-minded, looking for return, and ESG in the context of M&A?
Thank you for that. Is it working? Can you hear me? I'd like to share something that I heard in the last 2 weeks when I attended a conference. I think it was in Morocco. Do you remember when we were growing up, we always heard people say that once you're born, there are two things that are certain. Can somebody help me? Taxes and death, right? But we have another one now, I think. So the third category is climate change. You agree? So besides death and taxes, we're sure that we've seen in the last 2 decades and continuing to do so in the next 2 decades, that global warming has affected Africa more than anyone else, correct? So climate finance, I think, as Africans, we're very, very susceptible to that. So I don't think the case for making ESG a business case is done, I think. The question that you asked, whether it's a deal maker or breaker, there's no doubt that it's a deal. If we adhere to it, it's a deal maker. Only because we're expected, for example, we discussed the framework of ESG yesterday, and I'm not going to get into the details. So those companies and countries that are ready to embrace these frameworks and have strategies on E, the S, and the G, will have advantage, I think, in attracting investments globally. And Africa hasn't done such a good job so far. But I think with the work of IFC yesterday and the World Bank, and trying to apply it to many, many organizations in Africa, specifically in the case of Ethiopia, I think the banks, as launched yesterday, will take the forefront, and the rest of the private sector will follow. And I think that those that are ready, that are looking inwards in what their impact on the environment is, and in terms of their social responsibilities, they look at their employees, they look at the stakeholders at large, and everyone else in the value chain will get, I think, will be in a big position to get global funding.
Thank you. And maybe, Bernard, you want to chime?
Yeah, thank you very much.
Sorry, as you come in, Bernard, she thinks it's a deal maker. From where you sit, I want to hear your thoughts. And as you answer that question, are we actually there? Are we greenwashing? Are we just doing colorful documents just to get the investors in and get the deals done?
Thank you very much. And Hikmet has already started that conversation very well. But allow me to address it from what the CEOs are saying globally, from a survey that we do talking to many CFOs. And in East Africa, we talk to 55 CEOs on areas around ESG. And they say in the next 3 years, they'll be using ESG strategy to drive the business growth. And that we found very, very interesting. 55% globally, 48% saying in Africa, and 34% in East Africa. So out of the 55 CEOs, they are very confident that in the next 3 years, they'll use it to grow. How are they using it? In areas of attracting the next generation talent. If you come back to Ethiopia, what is the population size? You have the answer. What is the dynamics? You'll find there are so many young people. So those young people will not work for organizations that are destroying their future. If you want to understand, ESG is what we call the tragedy of the commons. We have a common grazing area, and do you imagine that tomorrow you will graze the cows again? So that's an area. Employee engagement, driving financial performance, and many more areas they are using. On the other side, from the shareholder value, they are now saying there is the social value that is now being calculated. Then the investors are saying, no ESG agenda, no ESG strategy, there is no capital. And I think that's the big dollar question that we need to ask ourselves. Now, coming back to where we are, you're asking, are we really there? Now, traditionally, ESG was housed in corporate social responsibility offices and communications, and then we just do those nice colors, taking pictures, feeding children, seeing the old, and all those things. And all of a sudden, we found we are stuck. And Hikmet has talked, and I think yesterday they talked about the evolution of reporting that has now brought the IFRS S1 and IFRS S2. Those who have adopted IFRS in the countries like Ethiopia must comply with that standard with effect from 1st January 2024. Now, in that particular, those two standards, they address ESG factors. So those ESG factors now will be addressed in the financial statements. And now, before, people were issuing financial statements and then issuing sustainability reports later. Going forward, they are going to be issued together in one document. And what does that mean? The investor will be validating, and there are levels of assurance on the financial statements when it comes to matters of ESG. So before, we would put a picture of Bernard doing something related to ESG, but they will come back and the auditors will be assuring that information. So yes, we aren't there, but I'm happy with the initiatives that we see taking place, a lot of developments taking place, and the ESG is quite huge. It is not what we are used to understanding. So yes, I can say we are making steps.
Getting there.
There are investments put into it, but there is a lot more that needs to be done.
Thank you. Let me take the questions. I think the first question was there. Do we have some mics? Yes, please go ahead. Just wait, back where you are. No, the table where you are here.
Okay, thank you, Branu from Ash Bank.
As you also address the question she's asked.
Thank you. I think it's a great question. And as we know, 95% or more than 90% of businesses in Ethiopia are SMEs. So they're really underserved, I believe. There's not a lot of financial products and services, as they don't have a lot of collaterals. So the access to finance is a challenge. But I believe with the capital markets coming in, I think that's going to be addressed. I know there's a fund of fund being established by UNDP. So that could unlock different opportunities, including access to finance for SMEs. With regards to SMEs, I think as an investment, when you invest in SMEs, either through investment banks, through debt and equity, and as they grow into a big business, into a medium business, obviously the revenue will grow. So as you exit, I think you'll have a larger ticket. But I agree, I think in Ethiopia, the enabling environment is improving day by day. There's a lot of initiatives coming in. I think the startup proclamation was just approved. But we need to learn a lot from our neighboring countries. I know Equity Bank has invested or taken the first step to invest in startups and SMEs. So yes, I think there's a lot to be made, but the capital market will, I believe, will unlock a lot of financial products and services to these SMEs and startups without without the traditional collaterals. So different products and services will come to the market, and I believe financial institutions will also follow those paths. Thank you.
Yeah, just picking up on what you talked about SMEs, let me give an example. And by the way, I'm not being paid by Equity Bank to talk about them. but actually started as a small, very small building society, very small building society. So people, small savers used to line up there to withdraw their cash. And I believe when I started my career, I'll find lines of people outside there. Perhaps I shouldn't have joined them that time. But I think that's how they started, as a very small SME. And look at them now. I think it's a consistent growth. I think their story is actually very good line in that. But let me talk about this question on microfinance, and perhaps pass it off to Hikmet to talk more about it. So why should you be interested if less like you are a successful microfinance bank, which perhaps is earning good income, there's good growth, everything is actually going for you. But essentially, you should also be asking yourself, should you then pivot? Should you become mainstream bank? Because we know there are some market banks that are working down that. And I think when you think about the story of this bank has gone through my mind, it'll come back to me. But we have actually seen some very good successful banks which started a microfinance bank. And to pivot to become mainstream, then they got investors and actually went in there. Yeah, the bank I want to talk about is Sissian Bank, which started as a small saving schemes in Uganda for the Catholic Church. And now Sissian Bank is actually one of the largest banks in Uganda. I'm sure there are others which have become big. And perhaps Hikmet, if you have financials, FSD, I'm sure these are some of the things you are looking at. Perhaps you can pick it up from there from me and also comment on the other question on quality.
Yes, I think to the SME question around what you're doing to ensure that they actually include in the capital market, but also the question around the audit quality and the status of the accounting body and everything.
I think in terms of trying to get funding for SMEs within the realm of FSD work, we are working closely with capital markets on their crowdfunding policies. And there are also several things in the pipeline which I can't disclose now, but there are examples, like you said, we've done work in Tanzania, we've done work in Kenya around that area. So I'll speak to that as we come to it. Let me address the question of my vision for Ethiopian Institute of CPA, and then thank you for the question, Barnabas. I think those of us that were around the profession know very well, and I tried to address it in my opening remarks this morning, that we don't have enough accountants and auditors to support the economy as it is now. This has been said back in 2007 in the World Bank report on report on observance, standards and codes, which will be updated this year, I think. So I think with the establishment of the Institute, we can expect many things. We expect a lot of chartered accountants in that space to be qualified within. We expect technician level accountants that will support the economy at SME level. And then we expect therefore we expect auditors to come through as they do their training within the current audit firms available in Ethiopia. But one of the things that I said, again, I think the Training Institute in itself, it's not enough. Accounting and Auditing Board of Ethiopia as a regulator has to be looked into. Is one of the fundamental regulation in Ethiopia to support, again, the capital markets and the economy of Ethiopia. So having said that, I think KPMG, and I know Bernard is looking at me, KPMG and many others like Deloitte and PwC have been wanting to come into this market, but not interested in the investment laws that permits them to be a partner at 49%, right? So I think the government of Ethiopia is looking at that, perhaps so that they can come in as separate entities. Again, if you go back, and I mean, any of you can Google. So ABBE as a regulatory arm is equivalent to PCAOB in the US, ISPAC in Kenya, and all the rest equivalents in FRC in the UK, and the equivalency in Africa. And you will see that if you say there's been no high-level court cases in Ethiopia regarding accountants and auditors. Correct me if I'm wrong. For example, the wrongdoings, consequences of an auditor giving a non-disclaimer perhaps on the audit report and going to court is unheard of in Ethiopia. So I think there should be a historical change where the regulator and the institute work together to make sure that the members that are that they regulate their members properly, and that whether misstatements are from fraud or error are actually taken to court in due processes. You will see that PwC, KPMG are here, and Deloitte have been fined quite a lot of money in US dollars in high-level court cases, correct? In Africa and beyond. And I think that's where we need to be at, to make sure that auditors are fined, and to make sure that finance professionals actually do their work. And when, especially now that we're going public with the stock market, that if there is a misstatement, that these professionals are called to order.
So thank you, Hikmet. And I think just to hide there, once you are on IFRS framework, your financial statements will be accessed and evaluated by investors across the globe, especially when now the capital markets will open to foreign investors. So it's a very critical thing. The last I checked, the standards are so many that not any individual accountant or auditor will move into it. There are people now specializing into specific areas of standards that help comply. However, as KPMG, we've engaged the Audit Services Corporation to begin with on conversations on how do you build capacity, the technical capacity to drive the audit quality. And I think that's something that we cannot discuss here and move into it. But I'm glad with the milestones. Hikmet, it was a bit faster when you were there, let me be honest. we could know what was happening at Abe, but I guess once the legislation that you talked to at the beginning of this conference comes into life, then it will drive others. Building partnerships, like ISPAC you've talked to, has built strong partnerships with other professional institutes globally. So again, Ethiopia, once the institute is up and they build that partnership, they will be able to support each other and drive the growth required for accountants. And especially when you start certifying accountants here, as opposed to the ACCA that only happens based in the UK, but also they will be able to certify accountants here as well. Now, going to the too big to fall theory, where, with reference to the Nigerian one. One, regulatory frameworks will always want to deal with less players. It is easy for regulator to deal with a few. Now, when banks come together, they come to, or when there's merger and acquisition, there will be a need that they are addressing. It could be a need from growth, it could be a need from compliance, it could be a need from regulatory better managing those particular entities. So when the too big to fall theory comes to play, is particularly when you look at the matters of financial crisis. And historically, why do those organizations fail is the big question that investors try to address. Now, being small and profitable does not mean it will remain the same into the long term. Coming together is very useful in terms of pulling resources together, technical capacity, and the skills that will be required. Hikmet has just talked about the shortage, the skills, but when you are big, you have the muscles to pull the resources. You have the capacity to serve even your clients better. You have the capacity to even grow the cake to be bigger in terms of profit and what is available for shareholders. So it's not that you have to fear that when the banks come together, there is the collapse side. When it comes to capital markets, and I'm sure Michael is looking at me there are criteria for listing that you have to meet, and there are criteria for you being onboarded on the capital markets. The requirement is very high to enable you also comply with the requirements that will be needed. We've seen entities in this country that have not been able to prepare even financial statements. Why? Because of lack of capacity. If you ask that bank, for example, because it's the example, and you ask, because you can't hire the best accountants that Hikmet will produce, because they will ask for higher pay, why not merge and get that? For example, you will need high-profile technology specialists in the areas that have been talked to, crypto, blockchains, and all that. Those technology resources are not cheap. So merging is one thing very good. As we become cautious of, will we fail? And we've had big corporations that have been run well without failing. I hope I've tried to answer that.
Thank you, Bernard. I think we will leave that question for now there, but if you think about Kenya, a couple of years ago, we had 44 banks. We are now at about 30, we are about many. But if you look at those 44, 39, or 37 banks today, the top 6, 7 banks account for close to 70, 80% of the market. Then you've all the others, about 30 of them. The question is, as you even deal with the question of consolidation matters that are here in this market, how many institutions do we actually need? And is there, yes, we are 120, but do we need those many? And are there synergies that can be unleashed by combining those banks? Maybe, Julius, and you'll have the last say on this because our time is up. As you respond to that question, there's a lot of focus on the financial market services, the financial services in Ethiopia. But from where you sit, thinking about capital markets, thinking about M&A, what are the sectors and what are the areas you foresee coming into the equation beyond the financial services, which is where the focus is at the moment?
Yeah, certainly the financial services sector leads as a key role in the growth of capital markets in basically almost all the countries they are looked at. When you look at the large listed entities across most stock exchanges across the world, they'll be in financial services sector. But the others are really consumer and retail, and because I think we need to talk about the population, the consumer people we have. So they'll be very interested in if you are in consumer, if less like you are in supply chain and distribution, as well as natural resources, energy and natural resources. So I think those are the where we'll see a lot of this, as well as actually on the social infrastructure, hospitals, education, and that kind of thing. We have seen a lot of trends in that. Digital, I did talk about as key driver, so we're seeing that. So those are the key sectors which we are seeing a lot of interest in M&A activity. But just going back to that question around the financial institution sector and the reforms happened in Nigeria. And I said there were many banks in Nigeria before the reforms of 2000. But the consolidation, which was driven by the regulator, by the way, and they just put what then looked like a crazy capital requirements, that shrunk the banks to 25. And there are benefits of actually having fewer big banks. Because when you look at our deals here, the infrastructure deals, you have to do a road which is being driven by private sector, and it requires $300 million. We have very few banks which can actually lend on their balance sheet that $300 million to one single bank. Unless now we are talking about the banks in Southern Africa and the banks in Nigeria. I can tell you in East Africa we don't. And the main reason is what we call, it doesn't mean they don't have huge balance sheets. They do have. But the regulator has what we call single lender limits. You can't give more than certain proportion of your capital to one customer. So in that sense, you need to be a big bank to be able to increase your capital base. And the few, I think he talked about the regulator and it deal with the others, because then also the chances of you failing when you are larger is actually fewer, is less. So there are those. We have also seen recently in Uganda where the capital requirements, again, core capital got increased, and some of the banks and to drop to become microfinance institutions where they now could not take deposits just because the capital requirements have actually increased. So for those ones which could not do a deal, they can do that. So I think there is a good thing to ensure that we have strong banks, and the reforms around the consolidation, just around making sure that we have big banks which can actually play bigger role. I think our solutions and financial solutions, us here in Africa, is really through our financial service institution. And so that and be able to localize some of the lending. And it's good that you have seen entities like the man set up because you have huge foreign currency risks. And I think they're able then to offer guarantees through that local currency. So you can actually do local currency lending. So if less like you're doing an infrastructure in Ethiopia and most of the other raw materials, assume most of them are locally here, why can that deal be done in local bar? Why should it be a US dollar denominated bill? So some of those solutions, I think when you get bigger and larger institutions, and perhaps which, in addition to them being regulated by the NBE and the central banks, they also have to answer the public through the ECMA and the ESX. Then that increases the transparency.
Thank you. And I think we're going to leave it there. The team is available, and so as we go for the break, please feel free to reach out and speak to any of them if you still have a question. But for now, thank you very much. And, it's been a pleasure interacting.